Okay, let's dive right in. Imagine this, drawn from the sources we're looking at today. You take SPY, the S&P 500 tracker ETF.
Right, the benchmark.
Exactly. Standard buy and hold strategy over a certain period. It gives you a 12.9% return.
Okay, decent.
But then, using a totally different approach, same stock, same time frame, the return jumps. It's not 12.9%, it's, get this, 39.98%.
Wow. Okay, SPY gained 12.9%. This other way gained 39.98%. Same stock. That's a huge difference. Different intelligence, as the source puts it.
Right. And the sources, they don't chalk this up to luck. They say it points to a different kind of intelligence operating in the market now, which raises this big question they pose. Is alpha, that edge, that extra return, is it dead?
A question a lot of people are asking.
Or is it maybe just waiting to be rediscovered, perhaps by machines? And that leads us straight to the core question for this deep dive. What if a machine, working with humans, could potentially beat the S&P 500 threefold over a period, and you wouldn't need someone staring at screens all day long?
And that's exactly why this is so important right now. I mean, the markets today are just fundamentally different beasts than they were even 10, 20 years ago.
Oh, so?
It's not just about earnings reports or economic forecasts anymore. Prices react instantly to news, sure, but also social media buzz, huge institutional trades hitting, layers and layers of algorithms trading off each other. It's incredibly complex.
So the old ways of thinking about skill, about alpha,
they might be falling short. They might be missing massive parts of what's actually driving prices in this new environment.
Okay, and the research we're digging into today, it introduces this specific framework for this new world. They call it Symbiotic Quant Intelligence.
That's QI.
Yeah. So our mission today is really to unpack that, get into these sources, figure out what SQI actually is conceptually, and then look at how it supposedly pulled off those kinds of, frankly, eye-popping numbers.
Absolutely. And to really get what's new here, we probably need to touch on the old foundations first, just briefly.
Makes sense, like alpha and beta.
Exactly. Traditional Finance 101, alpha is that return above the benchmark, right? The skill part. And beta, that just measures how much a stock moves with the overall market. It's market risk.
And models like CAPM, the capital asset pricing model, were built around these ideas.
Right. CAPM tried to link the return you should expect to that beta, that market risk. It's foundational stuff.
Beautifully simple, really. A cornerstone for thinking about risk and return for decades.
Yeah.
But the sources we looked at are pretty direct about the limitations of these classics, not just CPM, but others like Black-Scholes for options pricing.
Yeah, they don't pull punches. These models were brilliant for their time, but they were built on assumptions that just don't really match today's market reality that often.
What kind of assumptions are we talking about?
Well, CAPM kind of assumes investors are perfectly rational, markets are pretty stable, returns follow a nice predictable bell curve.
The normal distribution.
Right, and that an asset's beta is constant. Black-Scholes assumes things like volatility never changes, you can trade constantly without costs. Theoretical ideals.
Which isn't how things actually work.
Not even close, a lot of the time. Beta jumps around like crazy. Returns, definitely not a neat bell curve. We see extreme events, fat tails, way more often than those models would predict. Markets have momentum. They mean revert volatility clusters. It's messy.
So these models are still useful for something?
Oh, absolutely. For understanding core concepts like capital structure, basic asset pricing logic, the fundamentals of derivatives, they're still essential teaching tools.
Mm-hmm.
But they weren't designed for a market dominated by high-speed algorithms and instant global information flow.
Okay, so if the old roadmaps are based on a, let's say, calmer picture, and today's market is this complex, dynamic thing.
Yeah.
What is driving it now, according to these sources?
It's this whole ecosystem, really. You've still got fundamentals, of course. But layered on top, you have powerful forces like investor psychology, sentiment whipping around, amplified by social media. You have huge chunks of trading volume driven by machines doing high-frequency stuff, tiny arbitrages, momentum chasing, things humans just can't do at that speed.
News hitting the tape.
And being traded milliseconds later.
Yeah.
Geopolitical shocks causing sudden volatility spikes, complex interactions between different types of algos, institutional flows, moving markets. It all feeds into this dynamic, nonlinear system. Price isn't just about value anymore. It's about information processing, behavior, algorithms interacting.
Wow. Okay. So the market is this adaptive beast. How does something like Symbiotic Quant Intelligence even begin to tackle that? The sources emphasize SQI isn't about throwing out traditional finance. Right?
No, not at all. That's key. They position SQI as a complementary framework. Think of it like adding a new advanced sensor suite to your existing toolkit.
Okay.
CAPM, black skulls, they give you the basic physics. SQI is designed to augment human analysis by bringing in machine intelligence to spot things, signals, patterns, anomalies that are just invisible to humans trying to process today's flood of data.
So it's not just about speed, it's about seeing different things hidden in the noise.
Exactly. It's a shift, really, from being mostly reactive, looking at historical patterns, to being adaptive. SQI uses serious computational power to chew through massive amounts of data from all sorts of places.
Not just price and volume.
Right. News, sentiment, fundamental data, alternative data, whatever might be relevant. It uses complex algorithms not just to trade, but to actually discover new patterns and generate signals on the fly. And crucially, it uses feedback loops.
Meaning it learns.
Yes. The machine learning models are constantly learning, retraining, adapting based on what's working and what's not, and new data coming in. It's guided by humans, domain-informed, they call it, but the pattern finding and adaptation is machine-driven.
Okay, let's break down the key parts of SQI the sources highlight. First up, pattern recognition.
This is where the machine really earns its keep. It can scan just unbelievable amounts of data across different time frames, sectors, asset classes, looking at how things interact.
Things humans just couldn't track simultaneously.
Yeah, exactly. It can pick up subtle early indicators, find latent factors, hidden drivers that aren't obvious correlations. It can spot shifts in market behavior, maybe in sentiment or flow, before they clearly show up in the simple price action most people watch. It's finding those faint signals.
And the point of finding these patterns is often to uncover uncorrelated alpha.
That's a major goal, yes. If traditional alpha often comes with taking on market risk, beta SQI tries to find return streams that aren't just tied to whether the market's going up or down.
Why is that so important?
Because if you can find alpha sources driven by these unique machine-detected patterns, they might perform well even when the broad market is struggling. It helps build portfolios that are potentially more robust, more resilient through different market weather.
Now, the name itself, Symbiotic Quant Intelligence. That symbiotic part sounds crucial. It's not just machines running wild.
Absolutely not. The sources are very clear. This is a partnership. The symbiotic loop. Human plus machine. Humans set the goals, use their market knowledge to guide the machine, provide oversight, validate the outputs.
So humans are still in charge, setting the direction.
Definitely. They decide what kinds of patterns are meaningful, interpret the machine's findings. The machine does the incredibly heavy lifting, finding the patterns in the data, generating strategy ideas based on what it learns. Then the human feedback refines the machine, and the machine gives the human insights they couldn't get alone. It's this constant back and forth.
It needs human intelligence to work safely and effectively.
Critically, it's not a set it and forget it black box.
Okay, let's ground this back in those results, because the numbers are what grab you. SPY, 12.9% buy and hold versus 39.98% using this SQI approach in that period. How did it do that, according to the source?
Well, the source explains it wasn't just following some simple rule. The SQI model was adapting. For example, it detected specific signals in late summer 2024 things the source called trend compressions and volume dislocations. Essentially, subtle signs that the market's internal structure was weakening, that momentum was fading, supply-demand was shifting under the surface. Based on those adaptive signals, it proactively cut back risk, went defensive.
While others might have stayed fully invested.
Potentially, yes. If you were just looking at the main index price, maybe things didn't look so bad yet. But the models saw these underlying warning signs.
Okay, so it got defensive early. What about catching the upside?
Then later, say early Q1 2025, conditions shifted again. The model's specific indicators, things like breakout oscillators, trend shift detectors, started firing. These are designed to spot the start of strong moves, confirming a change in trend based on learned patterns.
So it saw a new upward wave starting.
It detected the signal suggesting strong buying pressure was building. And because the combined signal strength was high, it didn't just dip a toe in, it apparently entered with precision and scaled up its exposure quickly to catch that wave.
And this was driven by the model's signals, not gut feelings.
Purely based on its analysis of these dynamic, machine-spotted patterns. No fear, no greed, just adaptive execution based on the incoming data and learned rules. It learned and adapted.
The source has mentioned another case study too, right? SEZL, a more volatile stock.
That's right, SEZL, and it really underscores the adaptive point. The numbers there were even more dramatic in percentage terms. The machine learning component ROI was reported as plus 1,679%.
Whoa, compared to buy and hold?
Buy and hold was still impressive at plus 731% for that period, but yeah, significantly less. And they reported a trade signal success rate, a TSSR ratio of 75%.
So what was the mechanism there, according to the source?
Again, precision pattern recognition in a noisy environment. The source talks about using multi-wave indicators, basically, ways to filter out the short-term jitter and focus on signals indicating a more substantial real trend shift was underway.
So it wasn't just chasing every little price flicker?
Exactly. It was trying to identify the underlying structure. And crucially, the entry and exit logic was adaptive. The model apparently adjusted how aggressively it entered or exited based on how strong or confident the signals were at that specific moment.
So it wasn't rigid. It flexed with market conditions.
It suggests a system designed to handle the uncertainty you get with individual stocks, using machine learning to find that structure amidst what might look like chaos to a human observer.
Okay, let's pull back a bit. For someone listening right now, maybe managing their own portfolio or just trying to understand the markets, why does all this complex stuff matter to you?
Well, because you're navigating these same complex markets that can feel confusing, maybe less predictable than they used to, understanding frameworks like SQI, it's not just about maybe finding higher returns. It's about grasping how investing itself is evolving.
Right.
It helps explain why some traditional methods might feel like they're not capturing the whole picture anymore. And it shows how intelligence, both human and machine, is being combined to try and navigate this new reality. It really starts to redefine what we mean by investment skill today.
Less about perfect prediction.
And maybe more about building, overseeing, and guiding systems that can learn and adapt to whatever the market throws at them. It's about understanding the symbiosis, this partnership, and how it might unlock alpha sources that were simply invisible before.
So to sum up our deep dive today, the sources we explored paint a clear picture. Markets have changed. Speed, complexity, algorithms, global interconnectedness, this different ballgame.
Undeniably.
Traditional models,
Right.
foundational, essential for core concepts, but their assumptions often break down in this new world. Symbiotic Quant Intelligence, SQI, is presented as a vital complement.
Not a replacement, but an add-on.
Right. Using machine intelligence within a human-guided loop to find subtle patterns, adapt to changing conditions, aim for that uncorrelated alpha, and navigate complexity in ways static approaches struggle with. That seems to be the different intelligence behind those SPY and SEZL numbers.
It's about leveraging systems that learn, adapt, and execute in real time.
Which leaves us and you with a final thought to chew on. If markets are increasingly behaving like these dynamic adaptive systems, with machines learning, algos interacting, sentiment shifting instantly worldwide, what does that really mean for the role of pure human intuition or traditional analysis working in isolation? Is finding true alpha, that real edge, now less about one person's brilliant prediction and more about our ability to design, guide, and collaborate with intelligent systems that can learn and adapt as the future unfolds? Something for you to think about based on what we've unpacked today.